Hello and welcome to this session in which we'll discuss the guiding principles in integrated reporting. Now it's very important to review what we covered earlier. So on the prior session, we looked at integrated reporting and integrated thinking. And we said as a result of integrated reporting and integrated thinking, we produce the end product, what we called is the integrated report. Now in this session, we would look a little bit more about how to prepare this integrated report, some guiding principle. But it's important to understand what's integrated reporting, integrated thinking. We also looked at value creation. We discussed the 6 capitals and we discussed value creation process. So we completed all of those in the prior session. In this session, we will discuss a little bit more about the report itself. When we prepare the report, what are some of the guidance that we need to follow or would help us? So the purpose of the integrated report, which the byproduct of the integrated reporting and integrated thinking, is to provide a clear, comprehensive picture of an organization performance, including financial and non-financial factors. This is the whole purpose of integrated reporting, is to prepare a report. Now, the guiding principles in the integrated reporting framework, there's a framework, helps to make sure that these reports are useful and relevant. So the reason for these guidelines, they are given in a framework, they're called integrated reporting framework, to help us make sure that the report is useful and relevant for what? To give a clear, comprehensive picture of both financial and non-financial. So by itself, preparing the report comes with several challenges, which we will discuss those challenges later. So to help with preparing the report, the guidelines are principles, guides that are laid out in the framework. For what purpose? To assist, to help us in preparing integrated reports, in presenting the information in a way that meets the need of the stakeholders. Who are the stakeholders? Anyone that's interested in information about the company. Now bear in mind that these guidelines, these principles are only guidelines. What does that mean? It means they are principles, not specific or rigid rules. They cannot always be applied strictly, and they apply to different companies in different ways. But in this session, we would look at these guidelines, general principles that you should follow when you are preparing your integrated report. Now, bear in mind, later on, we're going to be a little bit more specific. We're going to be looking at something called the content element. The content element are different than the guidelines. So first, we'll discuss the guidelines. In the next session, we will discuss the content or the elements of the report itself. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Hello everyone. Are you struggling with your CMA exam preparation? Do you feel that your review course is moving too fast, too brief, or not covering topics in depth? Well, if that's the case, at Farhat Lectures, we can help you. We build your confidence through in-depth explanation, not memorization or reading the slides. What we will do is we provide baby steps approach to break down complex topic so you can truly learn, understand the material. How do we do so? We offer video lectures, we offer practice MCQs, we offer true-false questions, we offer exercises, we offer the notes. Understanding the material is the first step in passing the exam. Once you understand the material, you have gained the confidence to pass, and you can pass with Farhat Lectures. What can you do now? Start your free trial. You have a 2-day free trial. Take a look at it. Give us a chance. Your risk is 0. You like it, you keep it. You don't like, you cancel. Give us a chance. We can help you pass the CMA exam. The first of these guidelines is strategic focus and future orientation. Basically, what we're saying, the report should highlight how the organization's strategy impact its ability to create value. So tell us, how does your strategy impact your ability to create value? So link the strategy to creating value in the short term, medium term, and long term. Here you should show how the strategy influences different capital. For example, how will you be using your money to create value? How will you be using your human capital to create value? How you would be using your intellectual capital to create value in the short, medium, and long term, and how the availability, quality, and cost of these capital affect the value creation. What could be a good example? For example, implementing a new sustainability strategy could explain how this shift will improve long-term resource availability. So if you are somehow trying to save more resources, implementing new sustainability strategy, recycling, explain how this shift will improve long-term resource availability. And here you would be enhancing your reputation, which is your social capital. Remember, we talked about the 6 capital in the prior session, and create a long-term financial value. So basically, show me how you will be using your strategy, you connecting your strategy to your capital, and how your capital will create value in the short, long, and medium. Each company will be different. The second guideline will be connectivity of information. And this is critical because the whole integrated reporting is to connect financial and non-financial. The integrated report should present a holistic view of how different aspects of the organization, such as resources, risk, and relationship, are interconnected and influence the organization's ability to create value. So connectivity is a bedrock for integrated reporting. Financial and non-financial, your resources, what you have to your risk, and relate how all these relationships are interconnected. For example, a manufacturing firm might connect its investment in employee training to improve product quality. This is the connectivity. You show in the report that I am investing in my employees, I'm training my employees, I'm giving them more resources, high-tech resources, so I can improve quality, which in turn will do what? Will boost customer satisfaction, which will do what in return? Improve my financial performance, which is my financial capital. So I am connecting my human capital to my manufactured capital to my financial capital. So connect this information. Give me the big picture, your resources, your risk, and how these are interrelated. The third guidelines when you're preparing the report is discuss the stakeholder relationship. The organization should report on its key stakeholders, customers, employees, suppliers, investors, anyone that's interested in the company, and the quality of the relationship with them. So just talk about this relationship because these relationships directly impact the organization's ability to create value over time. For example, a tech company could report on its close relationship with its suppliers and how strong collaboration helps it innovate and maintain a competitive edge in the market. So if you have some sort of a win-win relationship with your supplier, some sort of a special relationship, for example, you buy only from suppliers that provide you raw material or resources from a country where they don't use child labor. Well, let's talk about this. Let's talk about this supply chain relationship. This is part of your stakeholder relationship or any type of a relationship that obviously that's going to create more value. So you want to discuss this. You want to discuss this stakeholder relationship. Materiality. Materiality means what? It means the report should include information that have significant impact. Think of materiality as something that's important, something that's going to make a difference in the person that's looking at the report. A significant impact on the organization's ability to create value. This means disclosing both financial and non-financial factors that are critical, important to stakeholders in understanding the organization. So anything that's material, that's important. For example, a healthcare company might disclose material risks such as regulatory changes that could affect its operation. Why? Because these have a major impact on the future performance and compliance. So anything that's important, the technical word is materiality. Now we're going to see later on in future recording about integrated reporting, this is going to be part of the challenges because how do you determine materiality? How do you determine something that's important? The answer is, we use this also, this concept is used in auditing. So if you're an auditor or if you're studying for the CPA exam, we use materiality a lot in accounting. Materiality simply, the simplest way to explain it is if it makes a difference to someone, it's material. And who's that someone? the average user. If it makes a difference to them, the information is material. But it's covered much more in details in an audit course. If you're interested, go to my audit course at farhatlectures.com. So that's another thing. Anything that's material should be included in the report. Conciseness. Well, what does that mean? It should be clear, to the point, and avoid any unnecessary details. In many CMA questions, they focus on this aspect, on this guideline, conciseness, and they say, for example, if there's too much detail, you violate conciseness. Conciseness has to be clear, to the point, and avoid any necessary detail. So the preparer must exercise judgment to determine what information is essential for stakeholder to understand the organization's ability to create value. A good example I can tell you about conciseness, where a company could give you information, but it's not concise. It's too much. It's confusing. A company named Enron. That company is gone. It filed for a bankruptcy. Enron basically stated in their notes, in their disclosure, what they were doing wrong, like what they were doing illegally. But they stated in a way that's not understandable even by not your average investor, by analyst. But they were not concise. It's there, but it's confusing. So don't do that, or don't put too much information. That's usually how they test it on the CMA exam. The company should provide a brief summary of its environmental impact initiative, focusing only on the major activities and outcome, rather than giving detailed breakdown on every minor initiative. So give information, but not information that's going to information overload, that's going to mislead or defeat the purpose of providing information to the users. Other guidelines: reliability and completeness, as it suggests. The report should be accurate, of course, and include all significant material information, whether it reflects positive or negative on the organization. Sometimes you might have to discuss negative outcome, and we talked about this. This ensures that, we talked about it in the prior recording when we talked about outcome and output. This ensures that stakeholders receive a balanced and trustworthy account of the organization performance. So give us everything, and that everything should be reliable. Anything that's significant should be reliable, and most importantly, complete. Give me the full picture. Okay, for example, a retailer might report both its strong financial growth and a recent data breach. So if they had a data breach, that's negative. But guess what? This is relevant, important for the stakeholders. So you want to be transparent. But also, they had a financial growth, that's positive. Give me everything, and give me everything reliably and in a complete fashion, because I want to ensure transparency on the issues that could affect the stakeholder trust. If you hide anything, that's not good. Another important guideline, not important, but again, we see it in accounting overall, is consistency and comparability. The information provided should be consistent over time. Why? Because if you're looking at an integrated report from year to year, you want to see what's happening to a particular issue, to their database, data or cybersecurity, or whatever relevant to you. It have to be consistent so you can make a better decision, to allow for comparison between reporting period. If you change your reporting, well, let us know. If you change anything in the subject matter itself, let us know. But otherwise, consistency is important, because consistency will enhance comparability. Now, it's very difficult to compare the integrated report across companies, because they might be using different subject matter. The way they look at materiality within each company is different. But at least within the same company, consistency and comparability should be the same. So any significant change in reporting or strategy should be explained. I mean, you could change, but explain it. While full comparability with other organizations is challenging, and we'll talk about that later on, effort should be made to provide consistency in key metrics. In certain numbers or certain statistics or certain figures that you provide, whatever those key matrices are, those KPI, make them consistent so the user can compare the performance from year to year. For example, an energy company could explain changes in its emission reporting methodology from year to year, that's fine, allowing stakeholders to understand and compare the data across periods despite the change. Even if you change, that's okay. Sometimes you might change because it better reflects what's happening, but you have to explain that change so we can compare, we can make our own adjustments. So those are few guiding principles. Now keep in mind, in the real world, as I mentioned, those are general guidelines, principles. Because they're not specific rules, it means professional judgment is necessary when using these guidelines. Because sometimes they can conflict with each other, the guidelines themselves. For example, there might be a tension between keeping the report concise while ensuring it's complete. Remember, concise is what? Concise is right to the point, don't give too much information. How about if you don't give enough information and you violate the completeness, where you don't give too much information? Sometimes they might conflict with each other. Now, each of these guidelines is designed to ensure that the integrated reports provide meaningful, balanced, and useful information for stakeholders, anyone that's interested in the company, while also recognizing the complexity of managing and reporting diverse organization, resources, and relationship. Each company is different. Each company will have different type of capital. Each company some companies might heavily be intellectual capital. Other companies might manufactured capital. So the way you prepare this report will be different from company to company, but at least you have some sort of a guidelines what to talk about. Now let's look at this multiple choice question from farhatlectures.com. How should an organization ensure reliability and completeness in an integrated report? So it's reliable and complete. Those are also part of the financial accounting reporting framework, reliability and completeness. A, by including only positive information to maintain a favorable image. Is this what we mean by reliability and completeness? No. And only, the word only, will definitely violate completeness. So A is out. It's an easy elimination. By ensuring that the report is free of material error, that's so far so good, and include all significant information, that's good, whether positive or negative, that's good. I would say definitely A is out. I will keep B. B is the report should be free of not all errors, major errors, include all significant information. Yes, significant information with any free of errors, material errors, and whether that is positive or negative. C, by focusing only on financial data and ignoring non-financial, definitely out. This is easy elimination, because the whole process of integrated reporting is to link financial to non-financial data by using estimates and forecasts instead of actual data. Now, this is like wishful thinking, and why would you use forecast if you have the actual data? We would use the actual data in the integrated report. Therefore, as we predicted, B is the correct answer. What should you do now? If you're studying for your CMA or any professional certification, CPA, EA, finance, accounting courses, go to Farhat Lectures for additional resources. We can help you invest in yourself, and Farhat is always here to help.